Hello everyone and welcome to your on-chain video for the Bear Market Survival Guide Part 2. And in this session, what we're really going to be looking at is what does a bottom formation look like? How does Bitcoin find these lows? And what are some of the on-chain metrics that we can use specifically within the advanced tier to try and identify when we're reaching that point of fair value, undervaluation, and bottom formation? So look, there is no single answer to this question. What is a Bitcoin bottom? It's the same answer as what is a Bitcoin top. And the answer is it really does depend on market dynamics. So what we're going to use these on-chain tools for, and again, these are all going to be advanced tier 2 level metrics. We're going to try and identify what are the signals that Bitcoin's starting to form an investor-led bottom. Because remember, the end of a bear market is typically when nobody wants to buy Bitcoin. The news is all bearish or non-existent whatsoever. And all that remain are the hodlers. They're the people who are the buyers of last resort. And bear market bottoms get put in when there is no sell side left. Essentially, all sell side has been exhausted and it's only the hodlers that remain. So what we're going to look at in this particular session is a number of models that I like to use that use valuation. They're trying to look for what is a fair value price. When has Bitcoin deviated so far from a mean, for example, so some kind of long-term average, where Bitcoin's getting into that very, very undervalued type zone where it's stretched too far to the downside. Now, remember, sometimes in these events, you do get these undervalue signals and it turns out to not be the ultimate bottom. But what we try to do by using all of these tools is we look for a thing that called confluence. We're looking for multiple metrics across multiple concepts that are all telling the same story. We want a cohesive narrative, and we want to see that a bottom is being put in across the board, not just one single metric that maybe the market isn't really looking at, or there's a dynamic that we've missed. By getting multiple metrics that are all telling us the same story, we can essentially put the probabilities into our favor that there is in fact an undervaluation at play. So just before we get started, please do give us a subscribe and leave a comment in the section below. We do like reading all of those. We learn a lot from you. This is really how we learn, not only to improve the Glassnode product, but also to bring these videos and show you what it is that you want to see. So do let us know what you're enjoying. And it's Team Dark Mode today again. Okay, so to start off this session, we're going to look at what is one of the most simple models that exists, and that is the Mayer multiple. Now, this is not an on-chain metric. This is basically looking at the 200-day moving average, which you can see here in the orange alongside the price. And the reason that we use the 200-day moving average in particular is actually because it's one of the most observed technical indicators in anything. Whether it's traditional finance or Bitcoin, the 200-day moving average typically responds as some kind of long-term average. And in general, many traders will look at it as showing the when it's trading above that price, the 200-day moving average, it's a bullish market. And conversely, when we move into the downside and we're trading below it, it's typically some kind of a bear market. So generally speaking, the 200-day moving average is kind of this long-term bull-bear cyclical indicator. Now, what we can see is the Mayer multiple down the bottom here, which is the ratio between price and the 200-day moving average. And the way to think about this is it's how far has Bitcoin stretched in terms of the price away from that long-term mean. Now we can see here in the 2017 mark, if we look at our oscillator down the bottom here, you can see that it trades down below this green zone. And this green zone is then wrapped onto a price level here, which you can see is almost picking the floor. And even though we were underneath that level, we stayed there for some time. Now, what this green level is mapping out, you can see up the top here, this is the Mayer multiple at a value of 0.8. Or in other words, we're trading at a 20% discount to the 200-day moving average. Now you can see that this persists for some time. We sometimes bounce back above it. And then in the final capitulation, we actually spend quite some time down below this level. It also caught this zone during the 2019, not quite the bottom, but it did then catch the March 2020 sell-off. Now we then re-entered that zone here after the June, July, and that sell-off that we had in the middle of the year in 2021. We found support on it down here in September or just hovering above it. And you can see we are now testing it for that next time. Now, as you can see here, this model typically picks what are long-term bottoms. It's starting to get into that undervaluation zone. It's showing that Bitcoin is at a 20% discount to the 200-day moving average. But remember that the 200-day in a bear market is a moving target. It's also descending. So naturally, 20% discount to that will also descend. So this is why we see that, generally speaking, it's bottom formation behavior And it is absolutely at the lower end of where we typically see Bitcoin. It's somewhere around 20% of Bitcoin's trading history has ever been below that 0.2 level, which is relatively strong odds, but it's also not zero. It means it can spend some time down there. And this is the same with many of these models. There is no one size fits all. There is no this is the bottom. What we look for is confluence across multiple metrics. So this is the first one. What we're looking at is that we are in an undervaluation zone and just really poking a head back above it. It doesn't mean that the bear market floor is in, but it's one piece of evidence we can use to say maybe we're starting to get into that value zone. Just pay attention though that our 200-day at the moment is trading sideways, which really describes 2021, where we more or less went sideways on a macro timescale between 60 and 30,000. So we'll have to wait and see how this plays out, but now let's move on and look at some of the other indicators we can add to our toolkit to kind of support what's going on here with the Mayer multiple. So now we're moving into the on-chain space, and I've built up a model here called bear market floor models. Now this particular chart will be inside the description below, so be sure to check that out. Now, a lot of these metrics capture some very, very old school original on-chain models. This is back from when on-chain as a discipline was really growing up in that 2018 to 2019 period. And a lot of the pioneers like Willy Woo, Coinmetrics, and Dave Puel coming up with a number of concepts on how we can really map out what does a floor model look like. So we're going to start with one of the simplest models, which is the realized cap. Now that's what we see here in orange. And what the realized cap does is it values every single coin in the whole UTXO set at the price when it last moved. So if you think about this, when you withdraw a coin at $10,000, let's assume you withdraw 1 BTC, you have saved $10,000. And until you spend that again, it will remain price stamped at that $10,000 price point. Now, what we see in bull markets is a rapid repricing. These are people who bought during the bear, selling, and that realized price gets scaled up. Now, what we can also see is that during a bear market, particularly down the very, very end of it, note how we fell down below this level here in November 2018. And we traded down there until that period in April where we actually popped back above it. I'll zoom in here to the 2015 market. This is, and by the way, this 2015 market is before realized cap even existed. It came out in the middle of 2018. So we didn't even know that this existed at this point in time. But you can see that we found bear market support all the way until we finally crashed down below the cost basis. It provided resistance as we tried to break above. These are people who just wanted to get their money back. The price comes back to their cost base and they say, that's it, I'm taking the exit liquidity, get me out. And we languished down here in 2015 for the entire year. We tested it again until we finally managed to break above the cost basis and away we went. So let's zoom into the next 5 years. And you can see that we found that same, we broke down below in November 2018, and it wasn't until April 2019 that we got back above the cost basis. So typically speaking, that realized cap provides a psychological support level during a bear. You can see that most of the wicks of these particular candles did come down and touch that realized price, but it wasn't until the end of the floor when we actually traded below it. So whenever the price is trading below the realized cap or the realized price, it's historically been one of those very, very significant accumulation, a generational bottom. And we can see we came back and tested it here on the March 2020 sell-off, and the market rapidly rejected that level. Now, from that point, you can see that we have not come back down to touch that particular model. Now, it's currently trading here at 24,100. So we could almost consider that perhaps, let's imagine, because the world is very uncertain at the moment, should we get some kind of significant capitulation wick, some major liquidation event, or some geopolitical turmoil that really does cause the market to flush out, we can almost think about this as being that high conviction cluster of on-chain support fronted by the realized price. Now, there's two other models you can see here, and these are the balanced price, which we can see here in pink, and the delta price shown in blue, which again are two of these models that Dave Puel and Willy Woo came up with back in the day. So to start off, the balanced price takes the realized price and it subtracts all of the spent UTXOs. It's the coin day destruction. It removes all of that spending behavior, and it almost captures what did investors pay for their coins. That's what the balanced price is trying to capture. And what you can see is it typically sits in between realized price and delta price. And you can see that it really captures kind of the lower end of this particular range. It touched the absolute wick here in March 2020. And if we actually zoom back to the 2015 period, you'll see a very similar effect. We had it trade below the realized price. It found most of its support along the balanced price. And note that the delta price, which is this blue model at the bottom, let's just zoom into these previous bear markets. You can see it caught the very bottom wick here in the blue, and then again, it caught the very bottom wick here in 2018. Now, the delta price is the realized price minus what we call the average price. If you took an average of every single day that Bitcoin has ever traded, that's going to be your average price. It typically trades much, much lower. But you can see that when you subtract the average price from the realized price, you get this kind of wick catching bottom. Now, where does this lead us at the moment? Well, as you can see, we are trading above all of these models, but you can see that there's a high density cluster down here between 24,000 at the realized price, 19,000 at the balance price, and then 17 at the delta price. Now, obviously getting down to that level is some scary stuff, but what we can see is that there's a clustering of these metrics that are really showing that that is the support level. And that first line of defense is that $24,000 position. So these are just some interesting on-chain models. I would certainly encourage you to go through in Glassnode Studio or find the descriptions down the bottom that can really help you understand the derivation of how these metrics came to be and some of the old school on-chain analytics. And one last thing before we duck off, not bear market, but in a bull, note how they all close up and they get very close to each other. Let's go back to 2013 and we'll see the same impact. Note how they all close up together. What this is showing is that the amount of spending behavior and the average price, all of these things are essentially collapsing towards the realized price. As everybody flushes out their coins, it's almost saying as a topping model that we've essentially got everybody believes that the current price is the correct price. This is the price everyone's willing to spend their Bitcoin at. So it doesn't just work in a bear market. You can actually use the collapsing of these metrics together to show that investor behavior of, that's right, this is the price and I'm getting out at scale. So there's just a little take home for anybody who's stuck around the video this long. So now we're going to get more into a couple of these oscillators that are trying to look for that fair value, that when Bitcoin is undervalued zone. Now what I've got here is the MVRV Z-Score, which is taking the realized price, taking our spot price and dividing it by the realized value. The other way to think about that, if you've got the current price and you're dividing it by your cost basis, it's how much unrealized profit is in the market overall. And this, at the same time when price goes below the realized price, you will have this oscillator enter into the green zone. Now you can see here that we're currently trading above that level, but it's starting to form somewhat of a bottom. And the way to think about this is back here in July, we had a similar level. This is where people saw value. They weren't willing to sell because their unrealized gains were sufficient that they're kind of happy to sit there at that level. So it's interesting that we're forming a similar level of support at that same zone. Now, should we get that major flush out and a capitulation wick, this is an indicator that we can pay attention to that's going to show when it was like March 2020, we dropped down into that green zone, if only briefly. And it's showing that investors have fallen back to their cost basis. And in theory, that should be a level where investors will go, well, at my cost basis, that's where I saw value in the past. It makes sense for them to step in and put value again at the other side of that. And much the same as the realized price, you can see that we also, and where we get that collapsing of all those on-chain models at the tops, you can actually see that we head up into this red zone for the MVRV Z-Score. And the beautiful thing about the Z-Score is it normalizes over time. If you haven't heard the term Z-Score before, it's essentially a statistical model that shows you how far you've stretched away from the mean on a statistical basis. How many standard deviations outside normal behavior is the current market. So it's much more reflexive, much more responsive than what we see in the standard MVRV. And that's because it's essentially normalized over time. So we can essentially see how this market evolves, and we should typically get similar levels showing up. So the last takeaway from this MVRV and realized price model is if we don't get some kind of a wick down here into this green zone, what it's actually showing is that there is market strength. Hodlers were less likely to sell and they'd rather stay the course. So that's just a piece of takeaway. If we don't actually get that revisit, doesn't mean it won't happen, but if we don't over the long term, it's actually quite a constructive view. It's showing that people saw more value in Bitcoin. Conversely, if we get a serious sell-off, this is where we can start looking at support. And over the long term, it has shown to be that more generational style bottom. Next up, we have the reserve risk. This is the metric that was originally developed by Hans Hodel. There is a reserve risk masterclass, which I'll link up here in the description. So I won't spend too much time going through the details of how this comes to be. Suffice to say that when we enter into the green zone for the reserve risk, what it's generally showing is that investors are hodling more. There's a lot less coin day destruction going on, and generally speaking, we're seeing this strength in the market. Now, the other thing to note is we spend some time down here, and you can see that it's kind of weighted to the downside. We spend all the way into the first half of the bull within this green zone. You can see that 2019 was largely all contained within it. And even though price was trading sideways, that heavy investor accumulation and the hodling, the lack of willingness to sell, created this downwards force, and it pulled this metric down into this zone. So not only does it bake in kind of that long-term hodling behavior, but it has investor sentiment baked into it as well. And you can see we've entered this zone. Now, that's obviously a constructive sign over the long term. It doesn't necessarily mean that the bottom is in, but it also shows that we're getting closer to the end of this bearish trend based on historical evidence than we are to the beginning. So it's a very interesting dynamic. We can actually see that this bear market arguably came in and started in this June-July period, which aligns with some of the other observations we've looked at over previous videos. But we are into this green zone. Typically speaking, we spend a long time in there, but just the same as the MVRV ratio, if we do start to get some upside momentum, that shows that investor conviction is there and that supply squeeze may be creeping in. Conversely, we can see that March 2020 spent quite some time in here and really flushed down to the lower end of this range, which has more or less been visited in the 2015 as well. So we do have a precedent for this taking some time to resolve. So the next model we're going to look at is called Entity Adjusted Dormancy Flow. And you may have seen some talk about this in recent times. And that is, again, because we've entered this green zone, which we've only done on 1, 2, 3, March 2020, 4, we tested it back here in July, and 5, we've actually spent some time in this zone now. Now, the entity adjusted dormancy flow is kind of this long-term bull bear indicator where, typically speaking, higher values are showing that people are distributing coins, there's coin day destruction going on, and that typically happens as price rises. Now, conversely, and similar to the reserve risk metric, when there's less coin day destruction and price is falling, we get hauled down into this green zone. Now, what you'll typically see, let's use our 2018 bottom as our base case here. We can see that even though we'd bottomed, typically when we get down to the lower end of this, what then happens is investors go, aha, this is extreme value. And the way that dormancy flow is calculated, we have market cap in the numerator and the amount of hodling behavior going on in the denominator. Now, the reason that this metric starts climbing, even though we're trading sideways down here at the very, very bottom of the bear, note how dormancy flow is climbing? That's showing that there is so little coin being spent. Hodlers are taking coins off the market, putting them in cold storage. If they started spending, you would see this distribution behavior. You'd see this thing get hauled down to the downside. This is the bear when it's heading on the way down. Lots of spending, lots of coin day destruction. Conversely, when they switch to hodling, which follows this capitulation event, even though price is sideways, remember, price or market cap is in the top of this metric. So if you've got price sideways, the only way that this can go higher is when hodlers are hodling. So that's why we get this climbing rate of return. And then we move back into the bear, we get our second flush out. Price is more or less sideways around the $10,000 to $12,000 range in through 2020, but nevertheless, this metric was climbing. So it's showing that almost prelude to when that hodling behavior is coming in, and it's almost an estimation of where that bear market may be starting to come to the end, at least on a sentiment basis. Now, we have also hit a bottom here when we traded down to 33.5. And note, it's not quite as strong as what we saw here in 2018, but it's starting to climb. Some of this is going to be driven by price, remember that. But if we start seeing this really climbing back to the upside, it's showing that hodling behavior is stepping in, even if price trades sideways. Now, conversely, a downtrend in this metric is not a great thing. It's showing one of two things. We're either getting spending by old hands, which is not great, or we're seeing that price continues to decline, which essentially means there's not enough demand. So really, we want to see this metric start to recover. If it's recovering while price is sideways, that's even better because it's showing that it's being driven by hodler behavior, not by price. If it falls back to the downside, that unfortunately is a less bullish scenario and may mean we actually need to form a bit more of a bottom over time. And the very last model that we're going to look at is called the NVT Price Model. Now, you will find this in Workbench as a preset here under our market indicators. You will see that we have a model here called NVT Price. And this is based off one of Willy Woo's studies where we have the NVT ratio, which is the network value to transfer. So the other way to think about this is like the PE ratio. How valuable is Bitcoin, the network, and how much is it settling in terms of transaction volume? And in theory, if lots of people are using Bitcoin to settle value, it should be more valuable. And vice versa, if nobody is using it, it should be less valuable. So what we have here is the 90 days shown here in pink. And what we're looking at is note that during the 2018 bear market, price traded much higher than the pink line. Now, the pink line is what you can think of as the utility value. How much value is being settled by Bitcoin? Now here, in theory, we are overvalued because we're trading much higher than the current network utility. Conversely, during the bull market, note how price is trading above this model. It's showing that on a fair value basis, we're essentially trading at somewhat of a premium. So we then have our oscillator down the bottom here, which is essentially mapping the ratio between our price and our 90-day NVT price. You can see here that we remain in this bearish trend, but simultaneously note that we're trading underneath the fair value as estimated by the NVT price. We did the same here during this May, June, July period where we traded below that fair value. And what this is indicating is that there is more transaction value flowing through the network than our valuation would imply. And you can see that we're down here in this very, very undervalued zone, which we really don't visit that often. We were here in the very first sell-off following the December 2017 top. We got down here again in March 2020. Arguably, we didn't even get down to this level during the 2018 bottom. Note how we traded somewhere above that. So really, we're trading quite some distance below the fair value that would otherwise be implied by the NVT price. And it's currently telling us a fair value somewhere up here around 55,000. Now, of course, that doesn't mean that we're suddenly going to zoom back up to that level, but it is showing that the amount of utility and usage of the Bitcoin network is perhaps a little bit higher than what our current valuation would tell us. So what we then look at is we have our Mayer multiple that's trading at a relative low. We have our reserve risk and our dormancy flow trading at lows. We have our NVT price, which is suggesting something that is undervalued at this point in time. Now, the other case is that we still have to see confirmation of some of these. We need to see dormancy flow bounce. We want to see whether we do in fact need some kind of a pretty scary wick to actually give us that MVRV signal to get into that green zone and let the realized cap provide support. But simultaneously, we now have a bit of a toolkit to start looking for what could come next and what does it tell us about surviving in a bear market. So to close out, thank you all for joining. Please do give us a subscribe and a like and let us know what you enjoyed in the comments. Hopefully you found this useful. Trying to discover a Bitcoin bottom is not an easy task. There is no one answer. We have to look for confluence across a number of different models. Now, in the current environment, there's certainly some confluence. We do have some things that are pointing to a fairly structural bottom formation, and it's kind of looking similar to what we've seen in the past. Now, with that said, things like the reserve risk and the NVT price, we've seen they can stay down in that undervalued zone for some time. So it's not necessarily that we're out of the woods, but we're starting to get to that time when maybe it's looking like that bear market floor is starting to be built. And what we really need to do is look and see how these metrics respond over the coming weeks and months. We want to see that market strength. We want to see that hodling continue. And what we don't want to see is all of those things starting to flip over and reverse back to the downside. So thanks for joining me. I look forward to seeing you in the next one. Cheers.